Thank you, Mark. Next up, for the next half hour, I'll be going through some of the insights and lessons distilled from 2 decades of empirical research on the investment realm. Okay, so these are a collection of some of my favorite results in investments, and you can broadly categorize them into 4 groups. Investor psychology, tapping into market inefficiencies, proximity to investments. I think these resonate with what Alex and Gerard talked about earlier on, as well as managerial incentives and characteristics. This resonate with what Mark spoke. So the basic idea is that if you want to crank up investment performance, if you want to juice up investment performance, what do you need to do? Okay, one thing you should do is you should understand investor psychology. You should understand behavioral biases that you are prone to getting yourself into. Next, instead of just understanding the mistakes that you make and the mistakes that other people make, why don't you take advantage of those systematic mistakes? Why don't you tap into market inefficiencies? Third, given the importance of information in this information gathering in this investment process, it's also important to ensure that you are positioned well in this information gathering process. So how do you do so? By being located or by being close to your investment targets. And finally, if you want to farm out the task of investing to an asset manager, and there are a couple of very good asset managers here today, then how do you do so? What kind of asset managers do you want to look out for? What kind of characteristics are associated with superior performance? What kind of incentives should there be? Okay, first up is investor psychology. We'll talk a little bit about something known as overconfidence. And the reason why we focus on investor psychology today is because of something said by Benjamin Graham. An investor's chief problem, and even his worst enemy, tends to be himself. So how do you become your chief problem? Well, in a market efficiency world, in a rational world, people think that investors only trade if the marginal benefit exceeds the marginal cost, at least on average. But if they are overconfident, if they overestimate their ability to select stocks that outperform the market, then trading can hurt their performance. So what does the data tell us? So this is a study done by Brad Barber and Terence O'Dean, formerly from UC Davis. And they looked at the performance of 78,000 retail brokerage clients. They essentially grouped the clients into 5 groups: high turnover versus low turnover. Okay. The high turnover guys have a turnover of about 20% per month. Low turnover guys hold their assets for long term. So the white bar essentially tells you, and the white bar is gross performance, that regardless of how often you churn your stocks, you end up with the same gross return. Your gross return is very similar to that of the S&P 500 index, which means that because these guys accumulate so much more commissions, they suffer a poorer performance. So the black bar is essentially the net return. So this suggests that trading is indeed hazardous to your wealth. That it's possible that people are doing so because they are being overconfident. So let's talk more about this overconfidence hypothesis. What's a great way to analyze overconfidence is to sort of think about different groups of investors who would be ex ante more overconfident than others. One way to segregate people based on their expected degree of overconfidence is to look at men versus women. Quite easy to separate. And psychologists have known for a long time, unfortunately for us, that men tend to be more overconfident when it comes to masculine activities. What are masculine activities? Examples could be driving or investing. When you look at the traders on the trading floor, most of them tend to be male. Okay, you look at F1 drivers, all of them are guys as well. Okay, so what does the data tell us about performance of men versus women? Are men more overconfident than women? And how does this pan out in terms of performance? So again, this is a study done by Barber and Odin called Boys Will Be Boys. And they find, unfortunately for us, that men trade 45% more than women and lose more on their trades. Because of excess trading, men's returns fall by 2.65%. Women are also overconfident, but they are less overconfident. Their returns fall by 1.72% per year because of excess trading. And they also look at single men versus single women, and they find that the differences are even starker on that front. So single men trade 67% more, end up reducing their returns by 1.44% more. Okay, so these results come essentially from some regression estimates. So if this is the first time you've seen a regression, don't worry. It's essentially all about trying to explain these variables with these variables. So anything with a star or asterisk is significant. So here we are trying to explain turnover or trading ability, trading behavior. So who tends to trade more? Turns out that single people, men and women, tend to trade more. A woman would trade less, maybe because she's less overconfident. If you're single and a woman, you trade even less. If you're old and wiser, you also trade less. Having kids or having a high income doesn't really change anything. It's like how you think. How about performance? Well, it's harder to explain performance. And it turns out that being a woman helps because potentially you're less overconfident. And being old and wiser helps as well. So these are some of the takeaways from their study on 78,000 retail clients in the US. So overconfidence is important. You must be aware of your tendency to overtrade. Okay, so we talked a little bit about the behavioral biases that people are susceptible to. How about trying to take advantage of those behavioral biases? According to Sun Tzu, if you know the enemy and know yourself, you will not fear the result of 100 battles. So what does the enemy do, and how do you take advantage of the systematic mistakes that other people on the markets make? So one mistake that they make, or people make, is that people tend to be inattentive to important information. What is an example of important information? It would be strong economic links between supplier and consumer firms. Turns out in the data that people tend to be inattentive to those links. Okay, so let me flesh the story out a little bit more. So here's a story about two stocks. One is known as Costcast, and one is known as Callaway. Okay, Callaway is obviously the more famous one. What does Callaway do? They are a retailer of golf clubs and golfing apparel, right? Costcast is the main supplier to Callaway. They supply golf clubs to Callaway. Okay, so look at what's happening to the stock prices sometime during the tech bubble of 2001. Okay, so in around June of 2001, the stock price of Callaway is defined by the blue line, and the red would be Costcast. Okay, remember that Callaway is the consumer, Costcast is the supplier. So you see that Callaway was downgraded because maybe people were too obsessed with what's happening in the stock markets to play golf. Okay. So price tanked by about 30%, but nothing really much happened to the supplier. Okay, logically, you would think that if something's bad is happening with your consumer, the supplier is going to get hit very soon as well. So nothing happened to the stock price. People were inattentive to these links. And lo and behold, after a month or two, Callaway came out and announced a loss. Okay, earnings per share of 4 cents. So what do you do if you are a swashbuckling hedge fund manager? Okay, the trade is you want to short suppliers whose consumers are doing poorly and buy suppliers whose consumers are doing well. Okay, so here are the results of that trade from 1981 to 2004, study done by Lauren Cohen and Andrea Frazzini from University of Chicago. And they find that this long-short strategy yields something called an alpha, a risk-adjusted return of about 1.5% per month. So there's about 18% per year. Some validation for this strategy is Andrea Frazzini used to work in University of Chicago as an assistant professor of finance. Now he's working at AQR, one of the leading quant market neutral shops in Connecticut. Probably running some sort of strategy that's similar to this, taking advantage of the mistakes that people make in the stock market. Okay, next up we need to talk about information. How do you get access to better information? What is the benefit of informational access? It turns out that information access is very important. So in a case study on Maverick Capital by Andre Perrault, Maverick is one of the larger equity long-short hedge funds in its heydays. Maverick's oft-stated goal was to know more about each stock in which they invest than any non-insider on the planet. So their investment professionals talk to company management teams, competitors, suppliers, consumers, as well as industry consultants and insiders. So obviously, information is very important to Maverick. And people are actually very shocked by the amount of work that Maverick does on each investment. So how do you get a leg up in this investment process? You do so by being located or by being close to your investments. One way is to invest only in companies that are geographically close to you. Okay, so what are the benefits of that strategy? Well, maybe we can learn something from here. So this is a study done on Asian equity long-short funds, comparing the guys investing in Asia from Asia. Those are the nearby funds, portfolio A, versus the guys investing in Asia from the US, UK, and other regions, and that's portfolio B. So it turns out that the funds that are investing in nearby securities tend to do better than the funds that are investing in faraway securities. Okay, so there is a tangible benefit to having better information access. Okay, easier for you to do the ground visits to talk to suppliers and consumers up and down the supply chain if you are located nearby. What are other ways to think about proximity? It's not just geography. Another way, as mentioned earlier by the other speakers, is culture or language. If you understand the language, if you understand the culture, it becomes much easier to get some insights into a company's future cash flows. So this is a story about Ken Watanabe versus Tom Cruise. Very easy to think about this. In Japan, there's obviously a huge language barrier. So who are the ones that outperform? Are they the Ken Watanabes of the world or the Tom Cruises of the world? The native speakers versus the non-native speakers. So it's very easy to do this in Japan because anybody, any self-respecting person with a Japanese-sounding name can probably speak Japanese. So we look at our data and we can easily group the sample into two native speakers and versus non-native speakers. Okay, these are Japanese-focused equity funds. And you find that, lo and behold, consistent with this proximity theory, the native speakers, the Ken Watanabes, outperform the Tom Cruises of the world by about 4.93% after adjusting for risk. Okay, you can do a double sort and look at the interaction between these language-based effects and geography, and you find the main takeaway is essentially that these are complements. So if you are located in New York, it really helps to be Ken Watanabe to know the language. Also, if you are a non-native like Tom Cruise, then it really helps to be located in Tokyo if you plan to invest in Japanese equities. Okay, so the takeaway here again is that information matters and it's good to be close to your investment targets. How else can you be close to your investment targets? Another way is through social connections. Maybe social connections built up through an old boy network. So people have done, okay, before I go into that, we were doing this study on proximity and geography, and we were thinking, why is it that people continue to invest in Asia from the US and UK? And the answer is simply related to what Mark has discussed earlier. It is much easier to raise capital, what Gerard has talked about, much easier to raise capital if you are based in the US and the UK, the traditional financial hubs. So we can look at the characteristic differences between guys who are based in Asia versus guys who are based in the US and UK. So this investment region head office indicator takes a value of 1 if you're based in Asia and 0 if you're based in the US and UK. So we look at how related they are to various hedge fund characteristics. And you find that the guys who are based here charge lower fees and set shorter redemption terms and end up still raising less capital. Which means that the guys who are based in the US and UK, even though they're underperforming the ones based nearby, charge higher fees, set more onerous redemption terms, and end up raising more capital. So there's important capital raising advantages to being located there. Okay, I talked about how else can you be close to your investments. One way is through your social network. So people have done an interesting study in the US on US mutual funds. This is a study done by Lauren Cohen, Andre Frazzini again, and Christopher Malloy. So we look at funds connected stocks and how they perform relative to the non-connected stocks. So how do they define connection? They say there's a connection if the fund manager and the firm's CEO, CFO, or chairperson of the board went to the same school. They both went to SMU, for instance. If they did that, then they're classified as connected one. Okay? If they both went to SMU and earned a business degree, then they're defined as connected two. If they both went to SMU and overlapped in 2002, it's defined as connected three. And the strongest connection will be connection 4. They both went to SMU, they both got a business degree, and overlapped in 2003. Okay? So here they could actually compare the performance of the connected holdings with the performance of the non-connected holdings. And as you can see, consistent with the idea that it's important to be located, to be close to your investments, not just location, the connected stocks tend to outperform the non-connected stocks. You can run the long-short strategy of this, and you find that connected 4 stocks outperform the non-connected holdings by about 7.84% per year before adjusting for risk, and actually 8.47 after adjusting for risk, okay, using some 4-factor methodology. Okay, what's driving this? Turns out that it's mostly related to informational access, because a lot of this outperformance comes about during days when there are announcements on, say, earnings announcements or announcements on Dow Jones news wires. Okay, most of the action happens when there are earnings announcements and when there are other news. Okay, last thing is, if you think about farming out the investment activity to a fund manager, what kind of fund managers should you go for? Okay, here's a little peek as to what kind of managers Julian Robertson goes for. Julian Robertson is a very famous fund manager, Tiger Fund Management. He ran Tiger Fund Management for many years. And he affectionately calls, Tiger Fund Management sounds related to lion, but he affectionately calls his managers tigers. And these guys eventually, when they go out and raise their own funds, they end up being termed Tiger Cubs. So what do the tigers do for an annual retreat? They would simply fly out west on Robertson's private plane, be taken to some very rural hilltop. They were split into teams, each equipped with a log the size of telephone poles, some rope, 2 paddles. They would then heave the equipment down to a nearby lake, lash the logs together, and race out to a buoy on the lake, with the twist that not all of the guys could fit on the raft, so some actually had to take a dip in the icy water. So this makes the usual retreat in Singapore sound like a walk in the park. Obviously, Julian Robertson likes competitive, ultra-competitive alpha males who can run 2.4 in less than 8 minutes. What kind of managers do you like? Okay, so the data has some, can shed some light on this. What kind of managers are helpful for investment performance? So Judith Chevalier from Chicago, I believe, and Glenn Ellison from MIT have done a study on US unit trusts or mutual funds again. And these guys look at some characteristics that may explain fund performance. Characteristics like age, MBA, and even something as bizarre as an SAT score. So the question is, do the senior guys, more experienced guys, outperform the young rookies? Or do the more driven young rookies outperform the senior ones? Do those guys with MBAs outperform non-MBAs? Do people with a higher SAT score outperform people with a lower SAT score? It's not easy to get the SAT score. They essentially use a proxy. They look at which undergraduate institution you went to and look at the average SAT score for that incoming cohort for that year. Okay, it turns out that if you just look at mutual fund returns, age matters. Okay? It turns out that the young ones outperform the senior guys. Okay, later, let's talk about why later on. MBA also matters. MBAs outperform non-MBAs by 63 basis points a year. Something as bizarre as the SAT score also matters. Someone from Princeton is the fourth highest SAT score school, outperforms someone from University of Florida, which is the middle school, by about 1% per year. Now, if you want to look at investment performance, you can't just look at returns, right? You need to adjust for risk, and you also want to add back fees. Okay, you don't want just to look at after fee returns. You want to add back fees to see their investment ability. So if you did that, what changes? Okay, turns out that age no longer matters. Turns out that the reason why the young guns outperform the senior citizens is because the young guns are more shy about charging high fees. They have less experience. MBAs also doesn't matter for risk-adjusted returns. Turns out the reason why MBAs outperform the non-MBAs in terms of returns is because the MBAs went to graduate school. They understood the relationship between risk and return. Higher risk, higher expected return. So after adjusting for risk, the difference goes away. The only thing that matters is the bizarre SAT score. So what's driving this? Well, it could be a variety of factors. It could be networking effects. Maybe you can do more networking at a good school. Maybe you are more hardworking. So industry, you're more hardworking. You've done like 1,000 iterations of the SAT exam. Therefore, you have aced the exam in real life. Maybe you are smarter. You have a higher IQ. So which story matters? Which story pans out? Turns out that IQ at least explains some of this. And here's, in my view, the most interesting study that I'm showing today is a study done by Matt Greenblatt, Maddie Keller-Harju, and Julian Linaiman. It's impossible to pronounce his name, and it's a Finnish. This is a study done on Finnish males. Okay, the nice thing about Finnish males is that all of them have to go through NS, and when they go through NS, they are required to take a 120-question IQ exam. So these guys actually know the output from that IQ exam, so they're able to classify people into 9 stay 9s, or groups, IQ groups. So the 1 to 4 stay 9 would be the intellectually challenged ones, and the 9 would be the Mensa guys. Okay, how do the Mensa guys perform relative to the intellectually challenged group? It turns out that lo and behold, the Mensa ones outperform the intellectually challenged people. So here we look at what these different stay 9s are doing during the tech bubble. And green implies that the group is entering tech stocks. Red implies they are exiting tech stocks. So early in the tech bubble, the Mensa guys are entering the tech sector, and they're buying from the intellectually challenged ones. And later on, as the bubble started to burst, the intellectually challenged ones are actually buying from the high IQ group. Sad to say. So managerial characteristics matter in more than one way. Incentives also matter. One way to look at incentives is to look at the hedge fund world. Okay, very easy to sort of split the hedge fund universe into highly incentivized versus non-highly incentivized fund managers using something called a performance fee. Okay, performance fee allows you to partake in the upside, so it aligns incentives on the upside. On the other hand, you have the high watermark feature that aligns incentives on the downside, at least it tries to. Okay, the whole idea is that if you lose 50%, you need to make up at least 100% before you can earn a performance fee. So this makes losses very costly for a fund manager with a high watermark feature. So we argue that highly incentivized funds should outperform poorly incentivized ones, and it largely pans out in the data. So guys with low performance fees and no high watermark underperform, guys with a high performance fee and a high watermark feature outperform. You can see that in the cumulative return graph as well, even after adjusting for risk. So I know I'm running out of time. The main takeaways for today are you need to beware of your bias to overtrade, the bias to be overconfident about your own ability. You need to try to take advantage of mistakes that others make, like being inattentive to certain things. It's helpful to invest in securities that you have a comparative advantage in. And lastly, if you want to farm out the investments to a fund manager, make sure the manager is smart and well incentivized to trade on your behalf to minimize agency issues. Thank you.